Hello friends, when you think about mutual fund investments, there are a lot of questions that come to our mind, like how do I build my mutual fund portfolio, or how do I align my investments with my financial goals, or how do I reduce uncertainty about my expectations. To know all these answers, please watch this video till the end, where we will discuss about how to build customized mutual fund portfolio as per your requirement, your risk appetite, your return expectations, and most importantly, your investment objective. Welcome to our channel Wealth Affairs. Subscribe to this channel and hit the bell icon to remain updated about all the fantastic videos that we share for your enrichment. Before going ahead with this video, I strongly suggest please watch our earlier video, Most Practical Way to Segregate Mutual Funds. The link of the video is given in the description box. In that particular video, we have discussed different kind of mutual funds in terms of their return potential and in terms of the risk that they carry. This particular video will help you to understand better in terms of what is the kind of process we should follow in our portfolio building process. Before going ahead with the portfolio building, it is very important to understand our requirement first. In the first thing in defining requirement is the time horizon of investment. It means that what is the time that we are ready to keep the investment. Next process is the flexibility of time horizon, which means is it possible to wait for some more time? Suppose you are investing for a 3 years kind of a time horizon, though there would be liquidity. If you want, you can withdraw it before 3 years, but still you should have some conceived or pre-decided kind of time horizon for any investment. Now, this particular point, which is flexibility of time horizon, says if required, can you wait for some more time, maybe 6 months or a year or 2 years, or you are not. There are times when when our goals are very fixed and we know we cannot wait beyond certain point in time. And at times, though we have certain investment horizon, but if required, we can wait. So this flexibility of time horizon is also important. Next comes the expected return. Now, in general, we'll always say that more is the better, but it is not true for all the investors. At times, we are looking at return which is just ahead of maybe traditional instruments, or at times when we are definitely looking at aggressive or very aggressive returns. Now, depending on our expected returns, we need to invest in different kind of mutual funds. The next is, are we ready to accept volatility in the return, right? Or in technical terms, it is called your risk profile or your risk appetite. Generally, as we have discussed in our practical way of segregating mutual funds, that if you are expecting very high amount of return, you have to carry more risk, and if you are happy with lesser amount of return, probably the amount of risk you have to carry is also less. Next comes the purpose of investment. When it is for a definite purpose within a certain period of time, our choice would be different compared to when our purpose of investment is to generate wealth over a long period of time. And finally, the age or the overall profile we are into, the kind of other liabilities that we have, the kind of cash flow that we generate on regular basis. So all these things put together, it is always advisable that you can write down all these necessary things and at one place before going ahead with the discussion of mutual funds. Okay, now as we are having all those answers, now let us see what kind of investment we can have in different requirements. The first, as we had discussed, about investment horizon. Second is the equity market impact. Now this will also signify the amount of risk that we want to carry. Then comes the purpose of investment, our return expectation, the volatility we want to carry or not, and finally the solution, what kind of investment we should go in. The first that I have put in here is the investment horizon where we are having less than 6 months of time. Generally, we should look at liquid kind of investment or overnight funds where equity market impact is nil, because these are the funds. In fact, all the funds that we'll talk about here, there won't be any equity market impact. The purpose of the investment is maybe some emergency funding, emergency fund that we want to keep. We don't know when the money will be required, or when we have a definite requirement within 6 months time. Now, the return expectation is generally more than traditional instruments like bank FD or maybe bank savings rate. There is not much of a volatility that we want to carry. Now, liquid or overnight fund would be best in this category because these funds are very low in volatility with very high credit quality and obviously no exit loads. Now, if we have little longer time horizon, we can look into ultra short term or low duration fund. While rest of the things remain same, now the objective of moving into a ultra short fund compared to a liquid fund is little higher return. Now, what happens if we have even longer time horizon? Suppose up to a 36 months kind of a time horizon where we don't want to take any volatility, much of volatility or much of no equity market impact. We can look into short-term accrual-oriented debt. And finally, when we are having even longer time horizon, which is say more than 36 months, we can invest into accrual debt fund with average maturity of 3 years or more. And particularly when we are having more than 3 years of time horizon and we are investing into debt instruments, we get indexation benefit in income tax. Now, this particular category are specifically having no impact of equity market. The volatility is obviously very low. The return expectation should be just ahead of your traditional instruments, and if you are having more than 3 years time, you are getting capital gain benefit in your indexation calculations. Now let us see what happens when our investment preferences change. Like our investment horizon remains 36 months, but we are ready to take some amount of impact from equity market. The purpose of the investment is adding some equity flavor, and where our return expectation is obviously higher than the traditional investment. The volatility, as we are taking some portion of exposure into equity market, there would be some volatility. The solution for this kind of requirement would be debt hybrid fund. Now, this kind of funds invest 25 to 30% kind of investment into equity market and the rest is into debt. We have created a separate video on debt hybrid fund. Please check out the link in the description box. What happens when we are ready to take little more equity, right? We get into balanced advantage fund. Here the return expectation should be between the equity oriented return and the debt oriented return. The purpose of the investment would be benefiting from the market volatility or the asset allocation, because the equity and the debt exposure into this kind of funds are dynamically managed. When the equity market goes high, the equity exposure is reduced in this kind of funds, and when the equity market goes down, the equity exposure is increased. Now this process continues over a long period and ultimately we get the benefit from market volatility. What happens when we are ready to take little more risk and obviously in the expectation of little higher return? Then we should get into equity hybrid kind of funds. Now this is little lesser risky compared to a pure equity fund, and we are getting return which are more aligned to equity market. The equity impact would be high as this kind of funds are investing more than 65% money into equity and the rest is into debt. This is the segment which is majorly hybrid kind of a segment, which we have seen. There are three broad categories, where one is debt hybrid, second is balanced advantage, and third is equity hybrid. The more we are coming down here in this list, the risk increases as well as the return potential of these funds. Now we are moving into equity category. Now when we are investing into equity category, the first thing is your investment horizon should be long and it has to be flexible. Like if required, we have to wait for a little longer time. Obviously when we are investing into equity, the equity market impact would be high. The purpose of the investment has to be creating long-term wealth. The return expectation is definitely significantly higher. That is why we are ready to take more risk. Now, when we are ready to accept volatility, obviously that volatility is very high and our return expectation is also high. We should look into large cap and multi-cap kind of a fund. And when we are ready to take very high amount of volatility in expectation of very high amount of risk, then obviously we can get into mid cap or small cap or sectoral kind of investment. Now this is very critical to understand your own risk appetite before you are entering into this category. As the return potential is very high, the risk that this category carries is also the highest. The best way to invest into this category is through SIP or systematic investment plan, where a fixed sum of money gets invested into equity market at a regular interval. There are few very good benefits of SIP, like as the money is invested into equity market over a period of time, the market volatility is taken care of. If you run the SIP over a long period of time, you get the benefit of compounding, and it averages out the cost of investment, because when the equity market is low, generally you buy more number of units, and when the equity market is high, you buy less amount of units. When creating the portfolio, we should understand the importance of asset allocation. Asset allocation means the proportion of different asset classes that we are holding in the investment portfolio. Alignment with goals. Now what does it mean? It means whenever we are investing, every particular investment should have a goal. Unless and until we are aligning the investment with our objectives, it is very difficult to actually attain them. Combination of schemes, you can have different schemes for your different investment objectives, so your overall portfolio would have a good bunch of schemes. Your investment would also be diversified. Few points again, just to reiterate: the importance of time horizon, the most important part of creating the portfolio. We have to keep the purpose in mind whenever we are investing. We should ignore the temporary incident. When different incidents are happening around us, we have to understand what are temporary incident and which are having permanent impact on our portfolio, and accordingly we should review our portfolio at fixed intervals and take on our necessary actions in the portfolio. Thank you for watching this particular video. Please like it, give your feedback in the comment section, share it with your friends, and subscribe this channel. Thank you.